Torsten, let me begin with you. You do these wonderful vignette notes. Which of your little vignettes describes the American economy Jerome Powell has to deal with? Which is the latest thing you see at Apollo that matters to Jerome Powell?
Well, I think what's really interesting in this statement is the weight on the highly uncertain effects of the banking crisis. And on the other hand, they are very explicitly saying the committee remains highly attentive to inflation risks. So it's still this incredible laser focus on inflation. And I do think that inflation in round numbers at 5% is still way too high relative to the 2% target. So they're still looking in the rearview mirror and saying, we just don't know quite yet how bad this banking crisis is going to be, and we just don't know, therefore, how much credit conditions are going to tighten.
Michael Gape and I would talk to you about the banking crisis, but you'd probably walk off the set with a hook for Mr. Moynihan, so we won't go there. Michael Gape, and I want to talk to you about Fed policy, and I want to get right to it off this press conference. What will we learn about the June meeting?
I think that the main thing on the June meeting is we can't rule out further policy rate hikes. We don't think we will need to raise rates. We think we're done. As Torsten said, we want to evaluate how the ongoing stresses from the regional bank fallout are affecting activity. But the message will be we don't know entirely that we're done. It's possible that the spillover effects will be limited. The labor market will remain relatively solid, and we may have to do one or two more. We can't fully rule out action in June at this point.
Where are we going to be June 14th? Bramo, let's talk about it. Let's go through the statement. So this is what they said back on March 22nd. They were talking about the financial stress. The banking system is sound, resilient. The extent of these effects is uncertain. The committee remains highly attentive to inflation risks. Let's go to the new statement. Second paragraph. Same stuff. Banking system is sound and resilient. The extent of these effects remains uncertain. Well, that's one extra bank that's failed since the last time they said that. And I wonder on June 14th if they'll be using the same language again, Bramo, and how many other banks we'll be talking about at the same time.
And that everyone will agree. Do you find it interesting that there was no dissent, given the fact that we've heard so much dissent in all the talk that we've gotten from some of these Fed members at a time where there is a great deal of uncertainty, but pretty polarized views and strong ones at that?
I find it very amazing, Torsten Slok, that there is no dissent today, do you?
Well, I do think that their focus on inflation is really just continuing. I mean, they have said for a long time, we got to get inflation down to 2%. And the honest look at the data is that inflation is just not moving down to 2%. And now you, on top of that, have the housing market showing more signs of recovery. And that has a weight of 40% in the CPI. And if home prices and owners' equivalent rent starts to go up again, you could really have inflation sticky at very high levels. So I think they're keeping the optionality, the flexibility here at the moment.
Well, Torsten, you've said credit crunch is coming. You said credit crunch was here. Isn't that going to take care of it for them?
Yeah, so the problem is that the credit crunch is somewhat remote from the recovery in the housing market because the labor market is still strong. So there's all these domino bricks that need to fall in place before we need to see the labor market soften. And Jay Powell has clearly said we need to see the unemployment rate go up. And we're just not quite seeing that yet. We'll see on Friday where we get. But you're absolutely right. There's a number of things that need to happen first. And it's all monthly data before we can come to the conclusion that things are truly slowing down. And therefore, inflation is coming down to that target.
Michael, can you weigh in on this? Basically, is the implication here that in the Fed's data, perhaps that we don't even see, the stresses in the banking system really are not that great, or it's really just been perhaps overblown by individuals like myself, and that actually the inflationary outlook is still the preeminent concern, even with the ability to possibly not raise rates?
I think that's a fair characterization in the sense that the statement says it is still the preeminent risk. That doesn't mean they're not worried about banking system stresses. They certainly are. They will show up with the lag. They don't show up right away. Our work suggests it could be 2 to 3 quarters, certainly a shorter lag relative to policy rate hikes, but it's not instantaneous. So I think they're in this balancing act where the macro data is still pretty good on balance. They think they're going to get some excess tightening out of banking system stress. Until they know where that lands, inflation is still the number one concern. I think that's what the statement's trying to balance at this point.
Torsten, to Dan Swank's question, how do we measure the lag effects?
Well, one data point we get next week, which is the Fed Senior Loans Survey, is at least one very important observation in getting how bad was it actually here in the latest data. And meaning we already get some information about the second quarter telling us what are banks' willingness to lend. Did they tighten lending conditions to large firms, to small firms? Overall, that will be a very important, at least, step on the way to figuring out how severe this is. But it's very clear when you think about it. I mean, the 14th and the 16th bank in the U.S. having, unfortunately, to collapse collapse and go under. I mean, two balance sheets of more than 200 billion. This is not just a small corner of the financial system. This is going to have a fairly significant impact. And as Michael was saying, the risks are that now financial conditions in the regional banks, of course, will tighten. And with the regional banks or the small banks making up 40% of all lending and 30% of assets in the banking sector, this is something that you should be quite worried about the downside risk for the macro